A 1031 exchange is a tax deferral strategy that allows real estate investors to sell a property and reinvest the proceeds into another like-kind property without paying capital gains tax at the time of the sale. This provision, found in Section 1031 of the U.S. Internal Revenue Code, helps investors grow their real estate portfolios while deferring taxes. How does a 1031 exchange work? Sell an investment property. The owner sells a property, but instead of taking the cash, they reinvest it in another property. Use a qualified intermediary, QI. The proceeds from the sale must be held by a QI, who facilitates the transaction and ensures compliance with IRS rules. Identify a replacement property within 45 days. The investor must choose a new property or multiple properties within 45 days of selling the original one. Close on the new property within 180 days. The purchase of the replacement property must be finalized within 180 days from the original sale. Defer capital gains taxes. If all requirements are met, the investor pays no capital gains tax at the time of the exchange. Key rules of a 1031 exchange. Like-kind property requirement. The new property must be of the same nature or purpose, meaning real estate for real estate, e.g., selling a rental property and buying another rental property. Equal or greater value rule. To fully defer taxes, the replacement property must be equal to or greater in value than the original property. No personal use. Only investment or business properties qualify, not personal residences. Strict timelines. The 45-day identification period and 180-day closing deadline must be followed exactly. Example of a 1031 exchange in action. An investor sells a rental property for $500,000. Normally, they would owe capital gains tax on the profit, but by using a 1031 exchange, the sale proceeds go to a qualified intermediary instead of the investor. Within 45 days, they identify a new rental property worth $600,000. Within 180 days, they close on the new property. Since the entire amount was reinvested, no capital gains tax is due at this time. This allows the investor to defer taxes and grow wealth through larger real estate investments. Pros and cons of a 1031 exchange. Pros. Defers capital gains tax. Allows investors to reinvest profits without an immediate tax burden. Encourages portfolio growth. Investors can upgrade to better or more profitable properties. Potential for unlimited exchanges. Taxes can be deferred indefinitely with repeated exchanges. Cons. Strict rules and deadlines. Missing the 45-day or 180-day deadlines disqualifies the exchange. Cannot use for personal property. Only investment real estate qualifies. Eventual tax liability. If an investor sells without reinvesting, taxes will be due. How to get started with a 1031 exchange. Consult a tax professional. Ensure a 1031 exchange aligns with your investment goals. For those looking to grow their real estate portfolio while deferring taxes, a 1031 exchange is a powerful wealth-building strategy.